Hi everyone, this is Rohit from Lifestyle Mastery, and I'm excited to have Elias Can, who's a principal at Grishin Robotics, which is a Silicon Valley-based VC fund focused on investing in early-stage companies in broader consumer categories. Welcome to the show, Elias.
Thank you. Thank you for having me.
Awesome. So, we've had, a couple of chats before, but, before we talk about how you get into Grishin Robotics, how did you get into this world of venture capital and startups? What got you excited about it?
Yeah, it's a great question. And I, for context, I started in venture in the fall of 2018.
Hmm.
And for me, it was about 3 years after I had graduated from undergraduate. And so was working for a firm in public equity right out of school and spent 3 years there. I was based on the East Coast, grew up in New Jersey, and the firm that I was working for was in New Jersey as well. And great kind of like first job for me out of school, had a lot of like diverse responsibilities there, got to work with different groups within the firm. Great like learning opportunity for me up front. Um, but for me, staying on the public equity side was less of like a long-term interest. I really kind of wanted to work with folks much earlier on and be on the side where you're kind of like helping and being able to support folks at more of an early stage type level. And something that was kind of influential for me there was an undergraduate had the opportunity to dabble in creating a few apps myself. Like it was a fun time to build on the App Store. This was like not to date myself, but like 2011 to 2015. So a bit
Nice.
of time ago, but it was a good place for me to kind of get exposure. And part of that as well was going to local meetups in the New Jersey area for other founders. I didn't really know what VC was as much then, but I'm sure there were other investors there. And I just remember like the feeling and the energy and the enjoyment that I had of going to those local meetups, meeting with other founders, discussing ideas, what they were working on, things like that. And so that was a nice influence for thinking about getting me excited and wanting to be more on the early stage venture side. Was just remembering back to those memories that I had in undergrad. And so when I decided to kind of make the move over to venture, I'd moved out to San Francisco, so changed coast and basically moved out there with the hope and expectation to find a full-time role in venture. And I was doing a training program out in the Bay Area that gave me some hands-on exposure to what it was like to work as a VC, getting used to the cadence, getting used to taking meetings, the type of questions to be asking. So a lot more of like practical experience of what being an investor might look like, and at the same time recruiting for kind of that first full-time role in venture. And fortunately, during my time out there in the fall of 2018, I was able to find my first role in venture and ended up turning into a 2-year experience for me out in the Bay Area that led us pretty much into COVID when I actually decided to move back to the East Coast and that Bay Area excursion.
Interesting. And you mentioned about New York and San Francisco, but uh, that after COVID, a lot of people had left Silicon Valley, but now people are coming back in. So, what's the difference between the New York and the Silicon Valley, startup culture?
Yeah, it's a really good question. And I was just out in San Francisco for Tech Week, and it kind of reminded me a little bit about the differences as well. I think with I think with San Francisco, I also just mentioned San Francisco specifically. Like I also spent some time in San Jose. Like I think the Bay Area itself, like there's even like pockets of different cultures within the Bay itself. For San Francisco, I think the beauty of it is like you're always running into people in tech wherever you go.
Yeah.
Like you could be going to coffee, the grocery store, like go to a bar. Odds are you're gonna like meet or run into someone there that is in tech or investing in tech. Like it's a nice microcosm of like high density of people there. I think in New York, the difference that I've seen is that it's more diverse in terms of I'm less likely to just run into someone specifically in tech or in venture when I'm out and about in New York. Like there's people from big finance out there. There's people in healthcare, entertainment, fashion. It's a lot broader in terms of spectrum of the type of like industries that people are in. And so I think there's pros and cons to both, of course. And I think both ecosystems are great, and it's nice to be able to have the perspective of having spent time in both. But I think just like that, that's definitely to me like one of the big differences is just like the type of people that you typically run into can vary between the two. Um, and I would say culturally a bit as well. Like New York is definitely has more of like a go out, you know, go to the bar, stay up late type of culture. I think out west it's a bit more like health and wellness and fitness oriented. So that can also like split you a bit in terms of which one you identify more with or fit more with into. But I think both ecosystems are great, and it's been really like a pleasure to be able to spend time with both because I think there's a lot of pros on both sides.
Mm. Interesting. And you had mentioned that you started with we see after during the COVID time. So and you're doing deals in 2020 21. So how does the deal structure, how's it different from doing in 2024 versus 2020 21 pre-COVID?
Yeah, yeah, it's a great question because it's definitely changed a lot. Like when I first started in 2018 out west, the default was in person. Like you were meeting founders in person. They were either coming to your office, you were going to them, or you're meeting at some kind of like neutral site for both of you. But the default was definitely in person. And for the first full-time role that I had in venture, I stayed there until May of 2020. So it was um, you know, like a couple months into COVID at that point. And you know, when I left to come back east, like we were just at the very beginning of having to default to virtual first. Because where I was living as well, we were under like lockdown from COVID, and so like the idea of meeting someone in person legally, you just couldn't kind of do it as well, just given the situation. But um, the last few years, I'll definitely say, because I did a couple smaller gigs from 2020 to 2022. And then when I joined the Grishin team full time in June of 22, so we're kind of at the back end of the pandemic. Everything's very much more like uh, virtual first as kind of the default. So that's been the big change for sure. Is the shift like pre-COVID in-person default, post-COVID virtual first as typically the default. Um, I think there's definitely and because there's no like universal answer as to is one better than the other. I think the nice thing with in person is you definitely have a more kind of like intimate relationship and uh, conversation that sometimes can be hard to be replicated online. Like there's just a
Yeah.
definitely at your core like a better feeling of like meeting people in person and shaking a hand and having like a face to face conversation. At the same time, I think there is a lot of kind of inefficiency there that virtual does a much better job at, in terms of like travel time for founders can be cut down, travel
Mm.
time for the other side for investors can be cut down. There's a lot of like logistical things there that defaulting to virtual makes much more easy and efficient. And I also think as well, like for where we look investment wise, like we broadly cover everywhere in the US. We also look at potential investments in Canada and the UK as well. If we were in more of a like default in person type of environment, it would be very difficult for me to be able to manage all of that. And especially because a lot of the founders I'm meeting are on the West Coast or Southeast or South, and so I think actually by having a more virtual first type environment right now, it gives you much more ability to have like broader coverage and meet more diverse folks that way as well than other than just like only being able to meet people local to your ecosystem or to where you're based. So that's definitely to me like a big plus of the virtual side is just like much easier to meet folks wherever they are. It's much more logistically simpler. And then, if things are going great, like there's always the opportunity to meet someone in person, but you don't have to do that
Yeah.
as like the first step anymore.
Got it, got it. Absolutely. And uh, do you think the remote work is there to stay, or do you think in next 3 to 5 years we'll be back to 5 days a week in the office?
Yeah, it's a good question. I know Amazon just asked
Yeah.
everybody everybody to come back, and I'm sure there's some people who are unhappy about that if they had relocated and now
Yeah.
all of a sudden need to come back. Um, I think here there's no perfect answer in
Mm.
terms of like what the right setup is. Because even for us, when we're chatting with companies on and these are like seed stage, so it's very small teams, like on a scale of like an Amazon or a Meta, I'm sure it's just like so much more difficult of a question and how you kind of manage that. But even for us, like looking at small teams, you know we don't want to force like an in-person or a remote first, like it's up to the founding team. And the one thing that we would think about though is it stylistically a fit with the founders, is it culturally a fit with what they're trying to build? I think that's the more important question of, does defaulting to more of an in-person or more of a remote type environment fit better with that founding team, who they're hiring, the type of culture that they want to build? There is, hybrid that's kind of like the in between of the two as well. Where someone sits between the three of those, I think it's really up for the team to decide, but it needs to be like a good fit with them and the type of culture that they want to build. So I actually think like all three, between remote, more in person, and hybrid, can all exist. It just really kind of depends on the company itself.
Yeah, yeah. No, absolutely. And you had invested into companies like Midwest Games, Supercharm, Playbyte. And what specific trends in the gaming industry attracted you to these investments?
Yeah, yeah, it's a really good question. And I'll say for the angel investments that I've done, like Midwest and Camlin, they would both fall into the category of a publisher. So they're actually not the ones creating the original IP or content in house, but they're essentially working with studios to help them on like distribution, marketing, localization. Um, and so in a way, it's kind of more of like a B2B service to studios in that sense. So it's not even like a pure consumer facing opportunity, um, which is where like we'll typically look on the Grishin side, or even for me personally, investing wise, is typically I prefer more of like the pure consumer facing. But I think the publishing space is really interesting from the side that um, games in general, like there's no silver bullet. It can be a win, it can be a loss, it can be somewhere kind of in between. And what we've kind of seen the last couple of years is a lot more quality coming from the indie space as well. And so it's not like the AAA studios that are constantly the best titles out there. It's a lot of folks who are doing either a first like a debut title or a second title. And so to me, the publishing space is interesting because they'll get more exposure to that indie side and work with, let's say a handful or potentially more, depends what their model is. Um, and so through a publisher, you as an investor in a way kind of get this like quasi, almost like VC like exposure to a lot of new studios by investing through a publisher, because their typical arrangement is usually something on a rev share basis with a studio, maybe an IP arrangement as well in terms of what a potential split might be. But it's more project financing, so they're less of equity investors and typically more project-based financing side. So it does give you this like interesting exposure to new studios by investing in a publisher itself. And I think for the two investments I've made there so far, Ben at Midwest, like he's a industry veteran, has spent a lot of time within gaming, knows a lot of folks, very polished, great public speaker, great online personality as well. I think he has a great ability to like galvanize and excite people. And so to me, like investing in him and investing in Midwest is a lot because of his personality, and I think the culture and messaging that he's driving with Midwest. And then Slava at Camlin, he comes from more of a consulting analytical background. He has a very kind of like thoughtful approach for what he's doing with Camlin in terms of how they can kind of like limit that range of either a game being like a huge success or a huge loss. Like, can he drive more consistently good outcomes for studios? I think that's like a great problem to solve, because a lot of folks will launch, and if it doesn't go well, that's kind of it for them. And so if he can reduce that band of, ideally, of course, more on the loss side, like if something's a great success, like they'll lean into that and help it grow. But like, can they reduce that band and likelihood of something not going well? I think it was a pretty like compelling idea and thesis that he had there, and some of the early title launches that they've had through Camlin as the publisher have kind of shown that model is working so far. So two kind of different reasons, but also between the two of them, but two reasons that I'm excited in both. And then for Playbyte, they're more on the pure consumer facing side. They are a hyper casual games platform with a prize and in-game kind of economy component. So I would almost akin them to like a virtual arcade in your pocket, in a sense. Like they want to recreate that feeling of playing like small games at the arcade, competing with friends, like seeing who would win. And then they have a prize layer to the app as well, where similar to like an in-person arcade, you can essentially redeem your tickets in the app for a real world prize, whether it's a gift card or some kind of like candy or a treat. But they've done a good job at mimicking what that in-person arcade experience is like, and putting it into an app. And I think because we invested from the Grishin Fund and led their round last year as well. Like we were really excited about this concept. We really liked that they were bundling a lot of games together in one place. They've been incorporating more social and multiplayer aspects to Playbyte as well, which is thematically a big interest area for us in terms of this convergence between social and gaming. And so there's a lot of great things that we liked about the product and what they had done so far. And then Diego and team, great guys, really enjoyed meeting them, the type of people that you're definitely like very excited to back. And they're great at tinkering. They're grinders. They work really hard. They're very open to collaboration and feedback. They're very easy to get along with. So I think those were all like big pluses to us, that we really like them and we really like what they were working on. And then, sorry to ramble, and then the last one is Super Jump. So Tisa and Chris, I had the pleasure of meeting them earlier this year, and got to meet them in person during GDC as well for the first time. Their creating games on top of Fortnite. So it's the UEFN ecosystem. So what folks are doing there is building maps essentially on top of the main Fortnite game. And we would kind of call that like a UGC studio internally. And what's exciting about the space is UEFN is still relatively young and new. It's only been around for in its current iteration about a year and a half. You look at Roblox, like they have a much longer history and a very like expansive developer network and a lot of like games in that Roblox ecosystem. The thinking on my side, like thematically, is like we can see something similar definitely happen on top of Fortnite as well, given how strong the player base is retained and grown, even coming out of COVID. And so when you have a large installed first party base, like there's a lot of opportunity to create on top of it. And so they're creating maps on top of Fortnite in that UEFN ecosystem. And they both come from a mobile gaming background. They know how to build and ship quickly. Um, they definitely have like a strong understanding of some of the early dynamics in the space so far. And so I was excited to back them as this is a kind of still a nascent space, but something that I think could definitely grow as more developers come to the platform as well.
Got it. So interesting, because in the last couple of years, you've invested into a lot of great founders. But do you believe that, the best founders need help from their VC? Obviously, you are helping them with capital, but do you think they need the help from VCs?
Yeah, it's a good question. And I think you could probably ask this to 10 different investors and get 10 different answers. My
Yeah.
philosophy here is I think from the investor side, it's great to be able to be supportive, collaborative. If there's things that they kind of want to crunch on or talk about, like be an outlet for them. But at the end of the day, like you as the investor, you're not driving the business. Like you're a passenger on the bus. Like the founders are driving it, and you invest in them because you trust and want them to have that discretion as well. Like we shouldn't, from the investor side, we're not the hands-on people here in terms of like steering it forward. That's why you're backing the founders to run it. So I'm of the mindset that like I'm always here to try to be helpful. Like, but at the same time, I'm not the one who's ultimately making the tough decisions. Like that's why I'm backing them. Makes me think of I remember reading a book by Phil Jackson actually, and he's chatted a lot in it about wrote a lot in it about how to be a coach for guys like Michael Jordan and Kobe Bryant, who are just like
Yeah.
such incredible superstars. Like what could he do as a coach that they can't do on the court to perform or something like that? Like he's not going to teach them how to be better players. Like so his philosophy was like, hey, can I do different things to like tweak mindset or make them think in a different way or like expose them to things that maybe they're a little bit more like straightforward thinking on but need to like think of it more from a different direction. And I would actually like parallel that a lot to the venture investor side where it's like we're investing in people who we think are superstars, and it's not our job to like hold their hand or like take them to the next place. It's more to like give them different perspective or give them different help when they need it. But they're the stars of the show. Like we're 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 not that person.
Correct. And where do you see all the core areas where, VCs or founders are not typically misaligned, especially in the last 2 years, it's been a difficult market conditions, but where do you see, the misalignment happening?
For misalignment,
Yeah.
yeah, it's a good question. Because yeah, a few years ago in 2021 and 2022, there were big upswing years of total investment and much faster velocity in terms of checks written, but also like the amount of capital invested both of those years. I remember seeing like I think recently Carta had put something out as well on state of the market recently, and you can just like go back and see those 2 years just look even more outlierish right now because they're just so high relative to even like where the past 10 years have trended, which is almost more of like a straight line, and then those 2 years are a really big jump. Um, the latter half of 22 and since then, it's been a much tougher market environment for fundraising, not only for founders, but VCs as well. Um,
Yeah.
I think on the VC side, the challenge has been a lack of exit opportunity, whether through IPO or M&A. And so when you're not giving distributions back to limited partners, it makes it much harder to go out and do an next fund when they haven't been seeing cash on cash return. It's just markups or some kind of like book of value in terms of where everything is. And then the founder side, like just given how aggressive that funding cycle was in 21 and 22, naturally people have become much more conservative now as well. The macro backdrop there of rates rising as well certainly kind of like exacerbated things, but um, it's much slower fundraising cycles now. I think pricing's come down a bit as well from 21 and 22. And so it's kind of been um, a period of a little bit of like sobriety on the fundraising side. I think for both sides, for founders and investors, because it's a tough market for both of them ultimately right now.
Yeah. Yeah, no, absolutely. I think we, if I'm not wrong, we just had three IPOs since 2021, especially on the SaaS side. But do you think the IPO market will open up and we'll have a lot more liquidity by next year?
Yeah, it's a good question, and I'm sure since we're on the early stage side, like the IPO market can factor a bit, but I'm sure if you ask like a pre-IPO or growth stage person, like it's definitely much more core and like time sensitive for them on that side. My thought is, do I think things will reopen as rates come down? I I do think it's possible. Is it going to be like a flood of IPOs to the market? I don't necessarily think so. And I also like rates went up very quickly as we went from a zero rate environment up to where we were kind of peak. And I think the Fed will most likely reduce rates on a more gradual, slower basis than how quickly they had to raise them. And so that's also why I see less of a likelihood of just like this instant flood of IPOs, is that the macro is going to get better, but it's not going to be like a quick flip. I think the other thing that has come up and has been discussed is there are like some time horizon benefits of staying private in terms of for companies themselves, like they don't have to manage expectations on a quarterly basis. They can keep a lot of that autonomy that they would have as a private company, and not deal with a lot of the external pressures that you have as a public company. And so could we see more liquidity in some kind of like secondary market for late stage private companies? I think it's definitely possible, and read recently that there's maybe like 10 or 15 late stage codes that are seeing a lot of like demand and liquidity in secondary markets. Is that there universally yet? No. And so I think founders are weighing some benefit, and executive and management teams, of going public versus staying private for a bit longer. And the other thing that we had in 2021 that's pretty much dried up is like that SPAC market. So that kind of like came in and out of fashion very quickly, and that was kind of like a vehicle for some companies to go public very quickly, which maybe investors were initially happy about, but then after that lockup period, depending on the performance of the public stock, maybe they were less happy about it afterwards. But that SPAC trend has definitely kind of gone out of favor recently, just given a lot of the performance that we've seen from that period. And so, yeah, between the macro, between like the debate on staying private and maybe some secondary liquidity as like an alternative, and then kind of the dry up of SPAC as well. I think there can be more IPO opportunity, but I don't think it'll be like an immediate flood of folks going public anytime soon.
Mm. Interesting. And what are some of the common pitfalls you see when founders make when it comes to valuations during fundraising rounds, especially they've had some down rounds and flat rounds in the last couple of months.
Yeah, yeah, it's a good question because yeah, flat rounds and down are definitely a bit more prevalent now. Um, I, I would say, and this is probably more more of a pitfall that founders might have had in 2021 or 2022, but was using valuation as a North Star in terms of trying to get the highest number possible for the round. Like I think there's definitely this balance between what's reasonable for the stage that you're at and what makes you happy in terms of dilution, what makes the investor happy in terms of dilution, um, and also what sets you up for a realistic next round. I think people get caught when they take too high of a number early on, and all of a sudden, like when you raise at that higher valuation, all of a sudden like the clock is on, and you need to hit the milestones to show that you're worth that in the next 18 to 24 months, and turn around and raise something at 2 to 3x higher than what it was to show existing that you're doing great, to show the market that you're doing great. It's a big burden of pressure immediately. And there's nothing wrong with finding like a comfortable middle ground for everyone in finding the right spot on pricing, because I think for early stage, like it's definitely more art than it is science often. And maybe as you get later and later, it's definitely more science because it's a lot more like business metrics oriented, comparables to who's trading at what on the public market. But early stage, it's really much softer than that because you have limited operational history, maybe some traction narrative, but maybe not a lot there yet. And so it's really kind of like finding the right balance of what you're comfortable with on the dilution side, what the investor is comfortable with, what's a good number that you're confident when you hit these milestones, you can be at X in 2 or so years if you raise at Y right now. And so I think people can kind of get a little bit ahead of their skis if they go too high on valuation early.
Mhm.
The other thing that like I would just warn people on is paying attention to preference and not getting into liquidity preference crunch where you give up, like the standard is 1x. If you give up something higher like a 2 or 3x liquidity preference up front, that's going to like carry through to almost any funding round that you do from there subsequently. Because if you give up a 2x at seed and I'm the series A investor, why would I not like want the same preference, if not better, for running leading the next round essentially? And so you can kind of get caught into this snowball of liquidity preferences stacking up very quickly. if you aren't as sensitive to it early on and do something that's non-standard, because sometimes folks will maybe trade liquidity preference to get a better number on valuation, and that can be really tricky as you manage it going forward. So definitely caution folks to like just be mindful on liquidation preferences, especially early on, because it can be a trap going forward that you really can't like get out of, more or less.
Yeah, no, absolutely. I think that's a great advice when founders looking to raise. And what do you think are the biggest tips for founders on how do you get the most out of the board once you have a board member or advisor? How should they utilize those board members to get the most out of them?
Yeah, that's a good question. And I'm assuming folks like the usual cadence is kind of on that quarterly basis. Like typically that's what we do with our portfolio companies as well. I think for folks on the board, definitely, because when you're there, you're definitely more intimately talking about the business. And so it's a good opportunity to get solicit feedback and advice on things that are happening operationally, maybe short-term plan, roadmap type items as well, maybe some longer-term vision ideation. But for board meetings themselves, I would imagine it's usually more grounded in what's happening now or this past quarter, or what we're kind of looking at short run here. I think the other thing you can kind of think of outside of those meetings would be like how can I leverage the network of folks on my board to maybe be introduced to a potential partner, potential customer, um, a new perspective to have around the table. So like maybe a new investor or someone from that side. Um, Network is definitely a good side that I would think about as well. Um, because I think you can get a lot of the more like analytical or critical type things in those meetings themselves, but then how do you leverage what they can use, what you can use the board for on the network side, like outside of that? I think that's usually pretty important for folks to think about.
Got it. And I quickly want to do the top three. What's your favorite business book?
Oh, favorite business book? Um, Good question. Uh, I have two that I like, and they're a little bit older as well. So I'm sure folks have more recent ones, but I really liked Hooked when I read Hooked. I think the first time I read it was like back in 2014, and that really just like turned a lot of wheels for me in terms of thinking about how do you create a consumer product that people want to come to subconsciously. That's like the golden level that you can reach. So love Hooked, really easy framework. It's something that I think about a lot, even to this day when I'm meeting and chatting with folks in the consumer space. So I would say Hooked is a good one. And then the other one that I love and I think everybody should read once is just How to Win Friends and Influence People. Especially for my job, it's very social oriented, and I don't mean it from the side that like everybody needs to follow what's described in the book to a T. But I think there's a lot of lessons in there, and even though it's a book that like is approaching 100 years old,
Yeah.
behaviorally we don't change that much or that quickly, and so I think there's a lot of lessons and tidbits in there that can be helpful or like reframe maybe your own behavior or how you like perceive a situation. Um, because again, it's not like everybody needs to follow what's in there like exactly to a T to be great at something, but I think it gives you a lot of ability to like reflect on how you interact or like your character in certain situations versus like what they describe in the book. So I think it's always like a worthwhile read for folks that have roles that are definitely like very like people oriented, which yeah, early stage venture is definitely very heavily people oriented.
Yeah, no, absolutely. These are great books. We'll put that in the show notes. And uh, if you could go back in time when you started your your career in the VC world and then Grishin Robotics, what is the one thing you would have focused on or done anything differently?
Yeah, it's a good question. I would say when I first started, I did a lot of this, but I would tell myself going back, just do even more of like in-person networking. Just given like it was such, I'm really thankful that I was able to spend time in the Bay Area 2018 to up to COVID because it was such a good chunk of time to have that in-person networking, and especially during COVID, how much I missed that experience when we were all stuck inside. And so I think I definitely did a lot when I was out there. I would say do even more, because it's just great to meet new people, great to kind of like expand horizons. Like you never know what can kind of come out of a great conversation with someone. It just opens more kind of doors on that side. So I guess, yeah, if I was talking to myself in 2018, I would say do even more on the networking, go to more events, go to more meetups, just do more because a global pandemic's coming. You won't be able to do it for like 2 years. So like go do more of it. And then on the Grishin side, there's nothing like there's nothing that I would necessarily change, because for me when I came into the firm, and because we look broadly across different consumer categories as well, like gaming and social tend to be our biggest two, but we've also done investments in fintech, in ed tech, in marketplace type areas as well. When I started here, I started really wide in terms of where I was looking for new investment opportunities. And so there's naturally some initial like friction and learning period of me better understanding like my team's preferences, where they really wanted to look. Um, how can I build more of my network in that like more vertical spot? And so even though I'd love to go back and say like spend more of your time just like on gaming or social, because those are like the places where we spend the most time, I actually think it was really beneficial to start really broad, because you kind of have to do that to start to then be able to build into more of a narrow focus and approach. And maybe if I had started too narrow to begin with, there could have been other opportunity areas that we had missed, or look back in retrospect and say like, I wish we would have like had a bit more coverage here early on to see if it was somewhere where we want to explore more. um, so I think it was good to have, like, I wouldn't change the fact that I had to start pretty broad when I started here at Christian, because I think it was good to be able to refine and better understand team preference in terms of where we wanted to be. Um, so I know that's not really an answer of what I would change, but maybe it's helpful perspective for folks who do join a firm that has like multiple interest areas. Like it can be helpful to start pretty broad, and then over time you're going to refine and kind of like specialize a bit more in certain areas where the team wants to spend more time. You're building up more network there. You're building up more kind of like industry thoughtfulness and experience there. So maybe just more of like helpful perspective for someone who's getting started in venture.
Yeah, no, absolutely. I think this is going to be really interesting for people who would want to get into venture world. But what's your favorite online tool? For example, Gmail, Slack, Zoom.
Oh, good question. I would say uh, I would say LinkedIn is definitely my favorite. I can't actually imagine, especially now in a more virtual first kind of environment. Um, I can't imagine my job without LinkedIn in a way because it's super helpful to have kind of that social proof and context behind who you are. For me personally, like I'm very against, well, I shouldn't say against, I'm very hesitant to do cold email. If I'm reaching out to a founder who I haven't met before or like want to get in front of them or, saw something about their product maybe mentioned on TechCrunch or happened to stumble across their website and I'm interested in contacting them, like, and I don't have someone who can make an intro, I'm usually default to a LinkedIn connection with some context in that connect request. I would do that 100 times over before sending a cold email to someone because LinkedIn just has the social proof. They can see who you're mutually connected with. Again, another layer of social proof. They can see like my background and history, another layer of proof. You don't have any of that context over email in like an easily accessible way. So yeah, LinkedIn for sure is like very very helpful in my day to day.
Yeah, and absolutely. I think it's also one of my favorite tools. And it is what's the best way people can reach out to you and know more about Grishin Robotics?
Yeah. Sorry.
Yeah, what's the best way people can reach out to you and know more about Grishin Robotics?
Oh yeah. Definitely shoot me. Like I said, definitely shoot me a message on LinkedIn. I'm super
Yeah,
active there. Um, I would say that's the best way to reach out. Find me on LinkedIn.
got it. We'll put that in show notes. Elias, thank you so much for taking our time and speaking to us. I really enjoyed my conversation with you.
Yeah, thank you for so much for having me. Great to be on here, and have a great rest of the day.